Welcome to Chapter 11. As you can see in the top, of course, we all know what the topics are covered. Depreciation, depletion, impairment, and disposal of fixed assets, intangible assets, things like that. And I just have us at the end of the chapter at the Review Center. And this is always really good to go through and just want to make sure that you know to do this. But the Review Center is a really good summary of all the key concepts. Obviously, if you read the chapter, watch the lecture videos, look at the PowerPoints, you'll have already covered a lot of this, but it's good to know in just kind of a small few paragraphs what the key concepts are. And so there's some key takeaways right here. You can obviously read through this on your own, but definitely take a look at these. What I like is that you just have some nice little definitions right here. And you have some other definitions here, which you can go back and find in the chapter. But if you know these definitions, that helps you a lot. And just kind of make sure that you're aware of that. And then we've got the next section with the key takeaways and the terms for that section and so on. So just make sure you go through and take a look at these. They have a nice little one-stop shop for the depreciation calculations right here. So that might be useful to come back and look at these right here and so on. So just if you need this information, it's just right there for you in one spot, which I really like. I think it makes it easy to find and so on. So take a look at this as you're working on your homework in Cengage. Maybe you need to have a little refresher or reminder about something. You can come back here and find that and look it up. So I'm just kind of scrolling through so you can see all of these. And there's quite a few here, and every chapter has something just like this. And you'll find it very useful. Here's the depletion information, for example. So take a look at that as you feel the need. And then I'm going to skip ahead a little bit, and I want to go to the review exercises and go through a few of these with you. This first one right here, and Susquehanna Company, they buy an asset at the beginning of the current year for $250. Estimated residual is $25,000. They estimate that the asset will be used for 10 years. Use straight line, calculate depreciation per year. And that one's pretty straightforward. I don't think you'll have too tough of a time with that kind of a question because that's a question that is asked frequently in accounting principles. So I would dare guess you've seen that one before. So I do have the answer on the screen right here for you to take a look at. And you can just see the formulas right here. Cost minus residual divided by 10 years, we get $22,500 per year. So that should be a refresher from accounting principles for sure. And this next one, I have the answer. That one kind of came along for the ride, but the next one, take a look at. Akron Incorporated buys an asset at the beginning of year one for $375. Residual is 15. The asset will have a life of 5 years. Calculate depreciation using sum of the years for years 1 and 2. So this is the sum of the years digits. Let me get it back on the screen. You already saw the answer before, but it's right here again. So remember how that works. The 15 comes from adding up 1 plus 2 plus 3 plus 4 plus 5. That's the 15. And this is an accelerated method, meaning you take more depreciation early on in the life of the asset and not as much towards the end of its useful life. They're asking us just to do for 2 years here. The depreciation base is 360. Multiply that by the fraction of, in the first year, 5 over 15, get 120, 255. And so in year 2, it's 4/15, 96, and so on. So kind of follow that pattern. They're only showing us for 2 years out of the 5, but that would be the same pattern you would follow for years 3, 4, and 5. Year 3 would be 360 over 315, and you get the picture for how that works. And the chapter has a really good example of doing that for an entire lifetime of an asset as opposed to just 2 years like this one did. The next one is 11-3, and this is Albany Company. They bought equipment at the beginning of year 1 for $75. The asset does not have residual value, estimated to be in life for 8 years. Calculate the depreciation expense for years 1 and 2 using double declining balance. Double declining balance. This is 11-3, and the answer is right here. So 75, and the rate is 25, and they show you how to get to that rate right here. So I take 200%, not 100%, but 200%, and I divide that by the 8 years. Okay, so 200% divided by 8 years. I'm doubling 100. That's my double. Divided by 8%, I get 25, and you can see kind of how that works. So recognize that the book value of $56,250 at the end of year 1 is my book value at the beginning of year 2, and that's what I multiplied 25% by to get to my ending balance of 42,187. So follow that pattern for all the years, but they just showed us the first 2 years. Okay, 11-4 is for depletion, and you can see right here it's for Utica Machinery. They buy an asset for $1.2 million. After the machine has been used for 25,000 hours, they'll sell it for $150,000. What's the depreciation rate per based on the hour per activity? And that's another method. There's lots of methods for depreciation. That's what we're going to learn. And right here, it's kind of like straight line, except for dividing by years. You divide by hours in this example, but it could have been miles. It could have been whatever the activity that you can easily measure is. Obviously, a machine like this that costs this much would have a counter on it, and that machine would track the hours used. And so they would track the hours used, and when they get to 25,000 hours, they expect that they would sell it. That's just fine. So we get the rate of $42 per hour to run the machine to depreciate it. So you can see the method right there. Very similar to straight line. That's one thing that makes it easy to remember, I think. 11-5 is, it says that Utica, same company as 11-4, is using the asset for 7,500 hours. Prepare the journal entry to record depreciation. That should be, again, a refresher. If you make intermediate accounting, that means you've passed accounting principles 1 and 2, which means that you've done depreciation entries. And you can see right here, we have a debit to expense and a credit to accumulated depreciation. And that's that rate of 42 that we just got done looking at times the number of hours that were used. So I debit the expense, I credit accumulated depreciation, which is my contra asset account. Okay, take a look at 11-6 right here. At the beginning of year 1, Herkimer and Company purchased a group of 7 laptops for its new hires. The laptops are purchased for $2,300 each with a residual of $500 each. Herkimer expects laptops to be used for 3 years. Compute depreciation for the group. So when a company buys a whole bunch of assets that are essentially the same thing, which obviously these laptops are, instead of tracking each one individually, it might make more sense just to do what they call that group depreciation. So it's pretty easy because it's the same concept as straight line. It's just that the only difference is I'm just doing them all in one batch as opposed to each one individually. Just kind of saves time, makes sense when you buy a whole lot of the same asset. And so you can see the formula here, same formula that we've used before for straight line. And you can kind of see that it's a 3-year asset. You can see the residual value, all that kind of stuff. And we're going to depreciate those laptops at $4,200 per year. In 11-7, at the end of year 1, Herkimer sells 2 laptops for $1,800 each. So we're kind of just continuing what we've looked at before. In year 1, prepare the journal entries to record the purchase of the laptops and depreciation of the laptops. So this is 11-7. And we'll get this on the screen here. So just some more journal entries again, just kind of how those work. We buy the laptop, 7 at $2,300, debit laptop, credit cash. We then depreciate them for that first year, which we computed up here at 11-6. And then we're going to sell 2 of them. And so when we're selling them, we sell 2 for $1,800 each, debit cash $36. Credit laptops for their cost, right, the $2,300 each, and then the depreciation on them at this point was $1,000 each, or $1,000 in total, I should say. And then let me just put 11-8 on the screen here. We'll go back and talk about it, and we'll come back. So 11-8, Buffalo Inc. uses composite depreciation for its assets. We own a car with a cost of $25, residual value of $15. Useful life of 5, as well as equipment with the cost of $75, residual $750, useful life of 10. Calculate their composite depreciation rate. So again, it's just another way to do this. They're just giving us all the examples here of how to do this. So you can see right here what they're doing, just keeping a table, cost, residual years, cost, residual years, and now I can go ahead and do it this way. Okay. Software will do this for us too. We're learning this obviously a very manual way on purpose. We need to learn the mechanics of how to compute these things and make these entries. But keep in mind that most companies that own a decent amount of assets will record these in software. They'll use software to make these calculations for you. You kind of run a report and it spits out what your depreciation entry should be. But you have to understand what goes into those calculations so you know if it's not working correctly or whatever. So keep in mind that software kind of looks like this. I've used software that looks a lot like this 11-8. That's kind of what you get out of it as a printout. Let's go here, take a look at 11.9. Assume the same information as 11.2. Okay, let's go back to 11.2, remind ourselves what that one was about. Right here, okay, you can see that one. They bought an asset, 375, residual of 15. Okay, so we're just going to continue question 11.2 with kind of a twist as we get down to 11.9. So remember, we had the 375, 15, $1,000 residual value, service life of 5 years. Let's go back down to 11.9. And same information, except we're going to change the scenario just a little bit. It says here, except that Acheron Incorporated purchased the asset on September 1, year 1, instead of January 1. Assuming depreciation for year 1 and year 2 are still using some of the years. So it's kind of what they call that partial year convention. And so let me show you that one, 11-9. And that's right there. And so that first year, it's for only 4 months. And that was kind of the big change between the two. So you kind of take a look at that. 4/12 times 120, you get $40,000. And then the second year, you kind of have two different things going on. You have 8/12 at 120 and 4/12 at 96, the amount that's left over. So you have to kind of now, it's a little bit harder calculation because when they buy that in sometime during the year as opposed to January 1, it's still the same methodology that goes into the calculation, but the timing's a little bit different. So I have to make two calculations every single year now, except for year 1, as I go forward and depreciate the asset completely. Okay, so that was 11.9. And 11.10 is kind of the same story here. They're doing a twist on 11.3. And I'm just going to put that one on the screen for you guys so you can take a look at that one. So here's 11.10. Also, you take a look at that. You can pause on the video or take a quick screenshot of your computer screen as you're watching this. And maybe you can replicate this if you want, or just take a look at this, how they came up with this answer versus what they're showing us, for the question on the screen over here. Okay, and then take a look at 11. This one deals with impairment loss. That's a good one to take a look at. I have no idea how to say this. Ani Onta, I'm not sure if I said that right. They're making it challenging for me. Owns equipment with a cost of $300,000, committed appreciation of 120. Present value expected net cash flows is 115. Calculate the impairment loss. Okay. So there's a little bit of a formula here. It's an easy formula. That's the good news. I like easy formulas. And it's right here. The impairment loss is fair value minus book value. Okay. So fair value is 115. That's the present value of the cash flows. That's the fair value. The book value is different. It's $300,000 cost minus depreciation taken, difference is 180. So my fair value is lower than the book value. That's called an impairment loss. And there's quite a few rules about that. You'll read them in the chapter, of course. But basically, GAAP says we have to be conservative, the GAAP accounting rules. And that means I shouldn't show an asset valued at more than it's really worth. I have to be really careful about that. So if the present value of my cash flows is 115, book value is 180, and I believe that's sustainable. I mean, if I believe that's the way it's going to be, this isn't just a little blip on the radar, that this is kind of a permanent thing, I'm going to write that down. Now, maybe, you get more cash flow out of that than what you expect, but GAAP says to be conservative, so I don't want to overstate the value of an asset. If I'm aware or believe it needs to be marked down, I'm going to go ahead and take care of that and do that. So that's what they mean. That's kind of the theory behind this particular problem. The few like that in your homework for the week for sure. 1112 is right here. The beginning of the current year, they have equipment that cost 50, has $35,000 worth of depreciation, being depreciated at 5,000 per year. They sell it for 12 at the end of the current year. Prepare journal entries to record both current year's depreciation and disposal of the assets. That's question 12. Let me get that on the screen for us. And you'll definitely have a few questions about these disposals of assets. So number one, when you see a question about disposal, always keep in mind you have to take care of updating depreciation. They were very clear about that in the question. They said record the depreciation, get it current. So that's always watch for that in the question. Do I need to record depreciation before I move on? And so that's what we're doing here for this first entry. Debit the expense, credit accumulated both for 5,000. The second then is to record the disposal. And always think of it about, you have to compare book value of what you receive against book value of what you're giving up. Okay, so just always think of it like that. Book value of what I receive compared to book value of what I give up. In this example, I'm receiving cash. I'm going to receive a check for $12,000. And I have to write off the old asset, it goes away, right? So when you're selling an asset, you dispose of it, both the cost and all the depreciation taken have to go away. Kind of just think they set sail, they go away. So cost has a debit balance, so I credit the cost for 50, as you see right here. And then depreciation has a normal credit balance, so I debit that, as you see here. So those two go away. Well, the net between 50 and 40 is 10. Okay, so basically think of it like this. I gave value of $10,000 away in exchange for $12,000. So I'm getting more cash. I'm getting cash at 12, giving up book value of 10. That's a gain of 2, right? I'm making money on this deal. So that's that credit gain. So that gain or loss is kind of your difference. That's, if it was the other way around, I need a debit to make this balance, and that'd be a loss. In this example, it's a credit because it's a gain. So just always kind of keep that in mind. Again, I'm going to say it again because it's that important. Compare the value received against the value given up. And that's how you determine if I have a gain or a loss. And possibly there's neither a gain or a loss. In this example, it was a gain. Okay, so that was 12. Take a look at 13, and this is depletion. And the nice thing about depletion is it's kind of like the unit of cost method that we looked at earlier. And so you see here that Ithaca bought land, $1.5 million. They're going to extract some tons of minerals. Residual is 250. The depletion rate is what? Assume they extract 25,000 tons in year one. What's the depletion for year one? Pretty simple stuff. You'll find these ones pretty straightforward. That formula should look really, really familiar to you, right? So it's cost minus residual divided by some measurement. In this example, it's tons of a mineral, right? That could have been almost anything is measurable. And we get a rate of $1.56 per ton. So what they do then is they calculate every year how many tons were extracted, and they multiply the tons times that rate to get to the answer. Okay, then we'll just do 14, and then we'll be good. For 14, this is using the MACRS method, and it actually comes from the appendix. And MACRS stands for Modified Accelerated Cost Recovery System. And most of you taking this class are probably potentially going off to get a bachelor's degree. Maybe yes, maybe no. But for those of you going off to get a bachelor's degree, and if you take a tax class, a business tax class, you'll come across that MACRS quite a bit. Some of you, maybe you're good with a 2-year degree here and you're going to start your careers. But if you do major in accounting and go on to get a bachelor's, you'll take a business tax class. And we use this term MACRS quite a bit in that class. And it's the IRS method that they come up with to do the calculations. It's pretty straightforward. The good news is it's really, really easy. And all assets fall into specific categories. And again, that's where software does a really good job. You tell the software what kind of asset it is, and it knows to apply the appropriate rates, which is pretty cool when it does that. But it's pretty simple. If you clicked on the appendix here, that would give us the rates. It's going to go right back to that section of the book where the rates are. And you can easily find that. You can see it's right here. I'm not going to go through that. You guys can find that on your own. But it's a very simple method to use, thankfully. And you can see what it is right here. Oops, I went too far. Right there. And so here's the base times the rates. And the rates go up. They kind of start in year one. They're typically not high. In years 2 and 3, this is a 7-year one. They kind of go up for a while, then they come down at the end. So the last couple of years are pretty small in terms of the depreciation, but the first few years are pretty high. Okay. Well, I should give you a pretty good example then of the various types of problems that you will see when you do your homework in Cengage. Hopefully gives you some idea of how to work them. Always review those key takeaways at the back of a chapter. I think it's just a good one-stop shop for the terminology, formulas, and so on that you'll use as you hit the problems. If you have questions throughout the week as you're working on these assignments, just definitely let me know. I'm more than happy to help you out. Otherwise, enjoy chapter 11.